At 72, the IRS forces you to withdraw from your traditional IRA whether you need the money or not. That required minimum distribution pushes you into a higher tax bracket, makes your Social Security taxable, and triggers Medicare surcharges. The tax deferral you earned for 30 years reverses in one mandatory withdrawal. Most people think of traditional IRAs as tax-deferred growth accounts. You contribute pre-tax dollars during your working years, the money compounds without annual tax drag, and you withdraw it in retirement when you're supposedly in a lower bracket. That framing assumes you control the withdrawal timing and amount. You don't. At age 72, required minimum distributions kick in. The RMD is calculated as your account balance divided by IRS life expectancy tables. For a $500,000 IRA at 72, that's roughly $18,250 in year one. For a $1 million IRA, it's $36,500. You must take that distribution and pay ordinary income tax on it, even if you don't need the cash, even if the market is down, even if it pushes you over a tax threshold. The common assumption is that retirees are in lower brackets. But RMDs don't care what bracket you're in. They're a forced income event, and they cascade into 3 separate tax penalties most people never see coming. First layer, the bracket push. Let's say you're married, filing jointly with $50,000 in Social Security and $30,000 in pension income. That's $80,000 total. In 2024, the 22% federal bracket starts at $89,075 for married couples. You're safely in the 12% bracket. Now add a $36,500 RMD from your $1 million IRA. Your taxable income jumps to $116,500, well into the 22% bracket. That RMD alone is taxed at 22%, costing you $8,030 in federal tax. But it gets worse. Second layer, Social Security taxation. Up to 85% of your Social Security benefits become taxable once your combined income exceeds $44,000 for married couples. Combined income is your adjusted gross income plus half your Social Security plus tax-exempt interest. Before the RMD, your combined income was $80,000 plus $25,000, $105,000. You were already in the 85% zone. The RMD adds another $36,500, making 85% of your $50,000 Social Security, $42,500 now taxable. That's an additional $9,350 in taxable income you didn't plan for, taxed at 22%. That's another $2,057 in federal tax. Third layer, Medicare IRMAA surcharges. Income-related monthly adjustment amounts kick in when your modified adjusted gross income exceeds $206,000 for married couples. Let's say your AGI before the RMD was $170,000. Add the $36,500 RMD and you're at $206,500, just over the first IRMAA threshold. That triggers an additional $70.90 per person per month in Medicare Part B premiums, plus another $12.90 per person for Part D. For a couple, that's $167.60 per month, or $2,011 per year. That surcharge lasts 2 years because IRMAA is based on income from 2 years prior. Now let's add it up. The $36,500 RMD cost you $8,030 in federal tax on the distribution itself, $2,057 in additional tax from Social Security becoming taxable, and $2,011 in Medicare surcharges. Total, $12,098. Your effective tax rate on that RMD wasn't 22%, it was 33%. And this happens every year. RMDs increase annually because the divisor in the life expectancy table shrinks. At 75, the same $1 million account forces a $43,668 withdrawal. At 80, it's $54,945. If the account grows at even 5% annually, the RMD grows faster than inflation. Over a 20-year retirement, a $1 million IRA could generate $1.2 million in RMDs and cost $400,000 plus in federal taxes and Medicare surcharges. The tax deferral you earned during your working years gets clawed back, with interest, because the IRS designed RMDs to force taxable events at exactly the moment you lose control over the timing. Here's the part most retirees miss. You can't avoid RMDs by spending down the account earlier. If you take distributions before 72 to stay under the thresholds, you're still paying tax on those withdrawals. The only way to bypass the RMD trap is to convert traditional IRA funds to a Roth IRA during lower income years, ideally between retirement and 72, when you're no longer earning W-2 income but haven't started RMDs yet. Those conversions are taxable events, but you control the amount and timing. A $50,000 Roth conversion in a 12% bracket costs $6,000 in tax. That same $50,000 withdrawn as an RMD at 75 could cost $16,500 after brackets, Social Security taxation, and IRMAA. The strategy is called a Roth conversion ladder. You convert just enough each year to stay under the next bracket threshold and avoid triggering IRMAA. It takes planning, but it's the only mechanism to defuse the RMD bomb before it detonates. If you have a traditional IRA and you're within 10 years of age 72, run a projected RMD calculation today.